Good morning, classmate. We are the Group 1 presenter. So, our topic today is all about addressing the working capital policies and management of short-term assets and liabilities. The first one is the reason why working capital is important. When we say working capital is important because it affects in many of the business from paying your employees and vendors. In short, working capital is the money to meet your current short-term obligations. Additional, working capital is a financial metric which represents operating liquidity available to a business, organization, or other entity, including governmental entities, along with fixed assets such as plant and equipment are also capital. We can also consider working capital as a operating capital.
11.2 Factors affecting the firm's working capital. Nature of the business. The nature of the business influences the working capital to a large extent. Financial and trading firms do not need enormous funds for fixed assets, but they need to invest large sums in working capital. Construction companies and manufacturers also need to invest little in fixed assets and more in working capital. Public utilities, on the other hand, need to invest more in fixed assets and less in working capital funds. Example of nature of business. Usually, when filling out some kind of form, nature of business refers to the type or general category of business or commerce you are describing. For example, if you work at McDonald's, the nature of the business is food services. Market and demand. Working capital requirements of a company are related to sales. However, it is not easy to determine the requirements of sales vis-a-vis working capital. Therefore, advanced planning of working capital is necessary for a growing company. A company that is in a rapid growth phase may need to invest funds in fixed assets. These companies also need to fund their growth with both internal and external sources. Therefore, the companies may not be able to pay dividends. In such a condition, a proper plan is necessary to maintain good working capital condition. Example of market demand is the summation of the total individuals' demand curves. Consider a shop that sells 1,000 pens on a daily basis. That means the shop has a daily demand of 1,000 pens. However, on weekends, there is an increase in the number of customers. Manufacturing cycle and technologies addition. It is important to note that in the case of manufacturing companies, there is an impact of technology on production. Some production, such as boilers, may need 6 to 20 months to complete the manufacturing and sales cycle, while daily usable products such as soaps and detergents have a cycle of a few hours. Therefore, different manufacturing periods are attached to different products and technologies for producing them. That is why companies must resort to different types of working capital condition depending on technologies and manufacturing cycles. Credit policy. Credit policy companies usually offer their products and services in credit to their customers in order to compete in the market. Credit sales, however, create debtors, and a company must not have a liberal credit policy to offer products to create a bad debt. The companies, therefore, should have a proper credit policy that ensures timely collection and a genuine credit policy for the customers. Example of credit policy is The company will extend credit to customers if they meet its threshold criteria for the granting of credit. The basic form of credit is a maximum credit of $10,000 with no security interest. The maximum credit can be expanded with the approval of the credit manager.
Tracing or tracking cash and net working capital. Operating cycle, length of time in which the firm purchases or produce inventory, sell and receive cash. Cash conversion cycle, length of time funds are tied up in working capital or the length of time between paying or working capital and collecting cash from the sale of inventory. Inventory conversion period, the average time required to purchase merchandise or to purchase raw materials and convert into finished goods and then sell. While average collection period, average length of time required to convert the firm's receivable into cash, that is to collect cash following a sale. Last, payables deferral period, average length of time between the purchase of materials and labor or merchandise and the payment of cash for them. Tracing or tracking cash and net working capital example. Johanna has a business that makes fun and stylish jewelry. She sells the jewelry to stores across the country, and the stores sell it to customers. Johanna's business has some assets, or things worth something to the business, just as cash, supplies to make new jewelry, and orders that haven't been paid yet. But the business also has some liabilities or things that the business owes. For example, Johanna took out a business loan and she has to pay rent on her workshop and office. Johanna wants to know how she should keep track of what her business owns and what it owes. To help her out, let's look at two important elements in asset management: net working capital and tracing or tracking cash through the accrual method of accounting. Net working capital. As we mentioned, Johanna's business has both asset and liabilities. How does she know if her business is financially healthy? One way to judge that is by calculating net working capital, which is the business assets minus the business liabilities. For example, if Johanna's business has $500,000 in assets and $100,000 in liabilities, then her net working capital would be $400,000. Net working capital gives a quick snapshot of the financial health of a business. A higher number is good because it indicates that a business has enough working capital or assets to pay for any expenses that come up in the future. A high net working capital also indicates that a company could expand the business. But net working capital can be misleading too. For example, Johanna's company has a large line of credit, which they can draw on if they get into financial trouble. This isn't reflected in net working capital. In addition, one chain of stores buys a huge amount of jewelry and pays for it every 3 months. So, if your company's net working capital is calculated in the month before the chain of stores pays for the order, it will be lower than in 1 month. It will be lower than in the month when they receive the cash. Tracing or tracking cash. Because net working capital can be deceiving, Johanna wonders if there's a better way. She is especially curious about how to track cash flow in and out of her company. For example, though the chain of stores only pays Johanna every quarter, she has to ship out jewelry to their stores every month. That means she's buying supplies and paying workers to make the jewelry every month, even though the company isn't paid for the jewelry until the end of the quarter.
So, how can operating cycle be reduced? Operating cycle is a ratio that measures the average number of days it takes for entity to sell its inventory and to collect cash from debtors for those sales. This is basically the numbers of days from the time inventory is purchased to the point where cash is received from customers for the credit sales of inventory. So, in generally, the lower the operating cycle, the better it is for the entity because it means that it takes fewer days for the entity to sell its inventory and receive cash for the credit sales of inventory. A company can reduce its OC in two ways. Accelerate the sale of its inventory. If a company can sell its inventory quickly, the OC should decrease. Reduce the time required to collect receivables. If a company can quickly collect credit sales, the OC will decrease. And here's the formula of operating cycle. And the example of calculate the operating cycle of the company.
So my name is Mark Aldrich Wallet. So I'm here to discuss about the policy that a firm adopt for short-term finance. So what is the policy a firm adopt for short-term finance? Short-term finance is an analysis of decision that affects current asset and current liabilities. The two aspects of short-term financial planning are the size of the firm, investment in current assets such as cash, accounts receivable, and inventory, and how to finance these short-term assets. So we have at least two elements of short-term finance. The size of the firm, investment in current asset. This is usually measured relative to the firm's level of total operating revenues. A flexible or accommodative short-term financial policy would maintain a high ratio of current assets to sales, and a restrictive short-term financial policy would entail a low ratio of current assets to sales. So number 2, the financing of current assets. This is measured as the proportion of short-term debt to long-term debt. A restrictive short-term financial policy means a high proportion of short-term debt relative to long-term financing. And a flexible policy means less short-term and more long-term debt. So, thank you.